Hello everybody, welcome back to another valuation investing video, and today in this video I'm going to be going over Cava stock, in which Cava Group is down almost 23% after hours. As we can see right here, the stock is down 22% after their recent earnings report that they just had today. If you didn't know what Cava is, Cava is a fast casual restaurant chain that specializes in Mediterranean cuisine, and particularly in customizable bowls and pitas similar to the Chipotle format. So this company is pretty much compared to Chipotle. It's basically the same thing, it's just slightly different foods. This is a more Mediterranean type style, so this is a restaurant company. Normally I don't really love to invest in restaurant companies, but we can give this one a shot and take a look at this company. Taking a look here, we can see the market cap of this company is 9.7 billion, but in the morning that's going to be reduced by 23%. So technically right now it's trading at about an $8 billion market cap. And with that being said, let's get into this earnings report of Cava Group. But before we get into this earnings report, if you guys would please hit the subscribe button down below. Just please help me out here. It doesn't cost anything. All it costs is you to move your finger and press the button. And only 10% of my viewers are actually subscribed to the channel. So please, let's increase that percentage. It doesn't cost you anything. All it does is help me out, and it helps you out to get more videos on your screen to watch me and to learn more about investing. So with that being said, taking a look at Cava Group, we can see right here Cava Group is a restaurant, and taking a look at the cuisine here, this is more Mediterranean style but similar format to Chipotle. Going to the earnings report from Cava today, they released earnings per share of 16 cents, beating estimates that were expected to be 13 cents. So they beat on the earnings per share. However, for the revenue, we can see they actually missed, reporting 280.6 million versus 285.6 million dollars expected. So with that being said, they did beat on the bottom line but actually missed on the top line. Right here, the restaurant company reported second quarter net income of 18.4 million, down from 19.7 million a year earlier. So year over year, the earnings have actually decreased. And net restaurant sales, however, has actually climbed to 20% to 278.2 million, largely thanks to new restaurant openings. And keyword, new restaurant openings. And getting into why the stock has been tanking so much is because of the same store metrics, which a lot of people like to see same store metrics because this is more organic growth. If you keep opening new stores, it doesn't necessarily mean you're going to be growing at a necessarily good rate, because your return on investment is going to be a lot lower than organic sales. And as we can see here, it only grew 2.1% during the quarter, while analysts expected 6.1%. So this was a huge miss on the same store sales, which really hurt this company. And you want to see same store sales increasing. At least they are increasing, but it's definitely a lot lower than what analysts expected. And Cava actually said that their quarterly traffic was roughly flat. A year earlier, the company's same store sales climbed 14.4%. So with that being said, it seems as if the traffic is slowing down in Cava and there's less people going in, but at least they are still growing with new openings. But I'd rather see them growing organically. But nonetheless, taking a look at the other big problem with this company is lower guidance. As we can see here, net new Cava restaurant openings are expected to be 68 to 74 this quarter. In the upcoming quarter, Cava's same restaurant sales growth is expected from 6 to 8% from May 15th, 2025, and then for August 12th, 2025, 4% to 6%. As we can see, same store restaurant sales growth is expected to decrease. This is the full year 2025 guidance. As we can see, the restaurants actually supposed to increase with this new recent earnings. They actually increased the net restaurant openings, but the net same store sales have actually expected to decrease to 4 to 6%, which is the one reason why this company is doing pretty bad after hours. Profit margin still expected to be the same. Pre-opening cost is actually expected to be larger, so that's going to be decreasing their profit margin potentially, even though they did say the profit margin here, but that does probably level out the amount they're opening. Also, the adjusted EBITDA did stay the same. So with that being said, once again, they did lower that net sales, organic sales from 6 to 8 to 4 to 6%. So that's the big reason this company is doing bad today. Taking a look here at the revenue growth of Cava, we can see over time it's definitely increasing. There is some variability each quarter, but that doesn't necessarily mean that's bad for this type of company. It is a restaurant company, so it does make sense that the first quarter will normally be higher than before. And if we take a look at the trends, we expect normally with this company from quarter 2 to quarter 3 to be a higher, but with this revenue, we can see actually they were almost in line with last quarter by missing on that revenue. So it didn't increase as much as expected. And taking a look at the earnings per share, we can see the earnings per share actually did beat estimates up here, and it's actually doing a little bit better than the revenue, but it's still kind of decreasing over the past few quarters. But once again, it does make sense with the trends of this company. And taking a look at what the bulls and bears have to say for this company, bulls have to say the brand expansion of Cava has the potential to define the category and bring Mediterranean to new markets across the country. So I would like to say that I think this company does have a decent moat. Normally a lot of restaurants don't have a huge moat because it is just food at the end of the day. Me personally, that's what I believe with companies like this. But they are in a pretty specific niche of Mediterranean food, and there's not much like that on the market besides, say, mom and pop stores or just small businesses. And also market position is the leading brand for Mediterranean fast casual segment. So they are the leading brand and they have a decent competitive advantage, but their financial performance with the bears, they say that it has fallen modestly below the street mean. So they are having difficulty launching some things like grilled steak in early June 2024. So this company is having slight problems with innovating on their menu. Also valuation concerns with this stock, but we're going to be getting into the intrinsic value calculator to see if this company should be a buy today. Taking a look at the 7-step stock analysis, this is the 7 key metrics that I like to look at in order to get us a good sense of the financial health of Cava. As we can see here, the P ratio, I want greater than 0, so that is a check mark at 54. That is a pretty high valuation because the market trades at about a 25 P ratio. But taking a look at the revenue growth, this is a lot higher than the market average of 10 to 15%. So both of these are almost 2 times the market average. So it's not a terrible overvaluation to me. But the biggest problem here is the forward P ratio. Analysts expect the earnings per share in the next year to decrease by nearly half, because taking a look at the P ratio to forward P ratio, normally you want the forward P ratio to be less than this P ratio because this is looking into the future of their earnings per share, and you normally want this to be less, which would show that they expect increases in the earnings per share. So that is a pretty bad X to me at 103 forward P ratio. That's a very high valuation. For the EPS growth rate, it is positive, which means it went from negative to positive, so it is growing pretty decently. This company has went from a losing money company now making money. Here the shares outstanding is a big problem to me, but once again, like a lot of companies that have recently IPO'd, this isn't too bad if you look at the whole story. Like you look at this 100% each year for the past 5 years, that's insane. But if you look at the graph, which we will when I use my intrinsic value calculator, this really isn't too bad because this was only right when they IPO'd and they tried to make money and dilute shareholders. But right now they've basically stayed right at their shares. They haven't done anything, so it's actually not bad. And the debt to equity ratio, while this is an X for Cava, it's not too bad at 57%. I normally want it less than 50%, but it's actually right in almost in line with the debt to equity ratio, and I'm actually surprised it's that close. Normally a restaurant company like Cava would have a lot higher debt, and honestly, it's not too bad. Honestly, I think this is actually pretty good for a restaurant in this industry. And analysts on average expect this to grow at about 21%. On some websites, they had said only 7% for the next 5 years. Some say 30+%. So I kind of went with the average here of about 21% for the next 5 years. So with that being said, let's get into my intrinsic value calculator to see at what price I'd be willing to pay for Cava Group today. So looking at this intrinsic value calculator that I created, the first thing I have to do is use assumptions of the annual revenue growth rate. For the bear case, I think this company has been growing at a little bit over 20% over the past 5 years. I think for the bear case, we could potentially, let's say, see this company grow, let's go 8%. For the base case, let's say 14%. And then for the bullish case, I'm actually going to go with, let's go with 20%. So I think this is pretty fair with an 8% bear case each year, base case 14%, bullish case 20% each year. analysts are kind of mixed on where this company is going to grow in the future. So I think this is pretty fair, 14%. This company is expanding very fast, and their same store sales are really lagging, but they are opening a lot of stores. So you would expect the revenue to grow pretty good. Now for the profit margin. I'm going to take a look at the past profit margin right here. As we can see, with the past profit margin, it's gone from negative 10% all the way up to 13 or so percent right now. So with that being said, I think for the bear case, with a restaurant like this, I think for the bear case, we can go 10%. For the base case, let's go 14%, and for the bullish case, 18% profit margin. I think that's pretty fair for a restaurant type company. Chipotle is right around this area, I'm pretty sure, so I think that's fair. Now for the future PE ratio, right now, as we saw, it's trading at about a 50 or 60 PE ratio. I think that's way too high for a company that's going to grow 8% each year, I think, for the bearish case. So let's put a future PE ratio of 20 for the bearish case. Now for the base case, let's go with 25 PE ratio, and then for the bullish case, a 30 PE ratio. Now for the shares outstanding, for the bearish case, I think that this company will grow at, say, I think for the shares outstanding, taking a look here at the shares outstanding, as I said with the shares outstanding, we can see here that actually over the past few, like 1 or 2 years, they haven't changed the shares at all. So honestly, with that being said, I think they're not going to change much. Let's say they actually increase shares at 1% for the bearish case. For the base case, say they keep it constant, and then somehow they get a buyback program for the bullish case. With that being said, I actually get, for the bearish case, a negative 17% return. For the base case, negative 1%, and for the bullish case, 14% return. So if you truly think this company could grow at 20% each year, increase the profit margins by a pretty good margin, by almost 500 basis points, and a future P ratio of 30, and if they buy back a little, this looks like a decent buy. But me personally, I'm staying away from this company. Say they grow at 20% and keep the profit margin at 14, which I think this is still overestimating. I think you could only make 4%. So me personally, I'm staying away from Cava right now, but please give me some feedback if you think that this company, I did some analysis wrong, but I'm just staying away from it right now, because with the base case, you would almost have to have this company grow 30% to even be worth it. I mean, obviously they need a higher PE ratio. So if you think this company, I think if it grows, if you think it can grow at like 20 to 20 plus, I think if you think that this company can grow at a 20 plus revenue growth rate, it doesn't look terrible. But honestly, I think this company is facing some problems in the future, especially with the same store growth. That profit margin will probably decrease, and over time, it's not going to be as organic. So with that being said, me personally, I'm staying away, like I said. Thank you guys for watching this video on Cava Group. Please subscribe, hit the like button, comment down below some feedback, and thank you.